for the first time in 9 months. A pretty big decision that's going to send ripples through pretty much every corner of the economy. And so now this leads us to the big question, which is, what does this mean for you, your pockets, your loans, your investments, and just your financial life over the next year or two? And in this episode, we're going to break it all down for you. So the Fed, they just lowered the main interest rates by a quarter of a percent, 0.25%, call it 25 basis points. It sounds like a small number, but trust me, it has some big implications. So here's our game plan. First, we're going to cover what exactly this cut is and why it's happening right now. Then we'll trace the path from the Fed's decision all the way to your wallet. We'll also talk about why your mortgage is a whole different ball game and what this means for the stock market. Finally, we'll look ahead at what's next for the economy. All right, first up, the cut. So, what happened? And more importantly, why now? Well, it all comes down to the Fed's incredibly delicate balancing act. This is the first time they've cut rates in 9 months. The main reason being that the job market is starting to look a little shaky and job gains have slowed. We're talking about just 29,000 a month recently. And now what makes this tricky is just that this is all taking place while inflation is hanging around 2% above target. And looking ahead, the Fed is signaling that they might do this a few more times before the year is over. This really gets to the heart of the problem. The Fed basically having two main jobs. It's called their dual mandate. One, keep as many people employed as possible. Two, keep prices stable. Well, right now, those two goals are pulling in opposite directions, right? So the weakening job market says, hey, cut rates to give things a boost. But inflation, which is still at 2.9%, says, whoa, not so fast. But hey, don't just take my word for it. Fed Chair Jerome Powell basically said it himself today. He called it a challenging situation and pointed out that the risks to the job market have grown. In other words, their biggest worry has shifted from inflation to a potential rise in unemployment. Hello, AI. And so that's why they made this big move. And okay, so how does a decision made in a boardroom in DC actually end up affecting your bank account? Well, let's trace the path. The process is actually pretty straightforward. It starts when the Fed cuts its rate, making it cheaper for banks to borrow money. So, what do the banks do? Well, they take action to lower their own internal rates, which they call prime rates. The prime rate, that's the number that a lot of your loan interest rates are tied to. So, this prime rate is the key link. Just think of it as the base interest rate that banks offer their absolute best customers. It's the benchmark for all sorts of variable rate loans like your credit cards or a home equity line of credit, a HELOC. When the Fed cuts its rate by a quarter point, you can bet the prime rate will drop by the same amount and fast. And of course, this creates two very different outcomes. For anyone with a variable rate loan, this is great news. You can expect to see a little bit of relief on your interest payments pretty quickly. But for savers, it's kind of the opposite. The fantastic yields we've all been enjoying on high yield savings accounts and CDs, well, they're going to start drifting lower. That era of earning easy, high returns on your cash sitting in the bank is starting to, go downhill. All right, let's clear up one of the biggest points of confusion. That happens whenever the Fed does anything, which is your mortgage, because it's a completely different story. Here's the most important thing you need to remember. Mortgage rates do not follow the Fed's main interest rate. It's just not how it works. Instead, the rate on a 30-year fixed mortgage follows the yield on the 10-year U.S. Treasury bond. That's the number to watch. You can see it plain as day right here. The Fed funds rate does its own thing, but look at the connection between the 10-year Treasury yield and the 30-year mortgage rate. They move together almost in lockstep. So if you're trying to figure out where the mortgage rates are headed, don't watch the Fed, watch the 10-year. Okay, let's shift gears and talk about the stock market a bit. How do lower interest rates impact your investments? Because they can definitely give a lift to certain types of stocks, especially in tech and growth. So to understand why, we need to quickly touch on a concept called equity duration. Trust me, it's not as complicated as it sounds. Just think of it as a measure of how sensitive a stock is to interest rates. Companies that are expected to make most of their profits way out in the future, think of many high growth tech companies, are said to have a long duration. It all boils down to some pretty simple math. When you're trying to figure out what a company is worth, you have to estimate its future profits and then discount them back to what they're worth today. The interest rate is a key part of that discount formula. So when the rate goes down, the value of those future profits goes up. It's a direct mathematical boost to their valuation. So what's the bottom line for investors here? Well, this rate cut is definitely a tailwind for good quality growth and tech stocks, and this is a really big but, rates aren't everything. A company's actual profits still matter most in the long run. And remember, the market can get really choppy around these kinds of policy changes. So being selective is still the name of the game. Okay, let's zoom back out to the big picture. What does this all mean for the economy? What are the potential paths we could be heading down over the next year or two? So where are rates likely going from here? Well, if you look at what the Fed itself is projecting and talking about, along with what the market is pricing in at the moment, it seems as if the path is clearly pointing down. The consensus is for rates to hit somewhere around 3.6% by the end of the year and keep falling to around 3% by the end of 2026. And that downward path really leaves us with two main scenarios to watch for. Scenario A is the soft landing that everyone keeps talking about and hoping for. The Fed keeps cutting rates gradually, the economy avoids a recession, and everything kind of levels out. Scenario B is that inflation turns out to be more stubborn and complex than the analysts and experts can even think of, and that would force the Fed to slow down or maybe even stop cutting rates, which would almost certainly bring a lot of volatility back to the markets. So as a side note, I feel as though this is a good time to bring up the fact that beyond all the charts and numbers here, there's a real human element to this, especially for Gen Z. The Fed chair Powell even brought it up today. He said kids coming out of college are having a hard time finding jobs. He called it a low firing environment. The real worry here is that something called scarring effects, where starting your career in a weak job market can actually lower your earnings for the rest of your entire life. It's mostly because of the economic slowdown, but AI's role in changing entry-level jobs is also a factor. While a small factor now, being that we're in the beginning stages of building out these AI tools, it's only going to increase its role in our life, right? So Gen Z, especially, and everyone else out there in the job workforce, continue to update yourself and implement, better habits, discipline, study habits to get new skills and continuing to make yourself of value to the workforce, because it is rough out here, as the Fed chair and every expert, continues to comment on, right? And so to finally wrap it all up, if you remember just three things from this video, make it these three. First, relief for borrowers with credit cards and HELOCs is coming, and it'll be quick. Second, those high yield savings accounts are going to start going away quick, people. And third, while lower interest rates do help growth stocks, at the end of the day, strong company earnings are what really drive returns and great fundamentals, as well as other numerous factors. So do with that as you will. Because remember, this is not investment advice. Leading us to our final $1 million question. With the Fed now changing their course, have they done enough to guide the economy to that perfect soft landing, or are we just entering a new phase of turbulence? Only time and the next few months of data will tell. Please leave a like, subscribe, and comment down below. Until next time, thank you guys.